Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So I don't know if you know this, guys, but $4.6 trillion worth of market cap is reporting this week. It was the third, I think, busiest week for the S&P in terms of earnings. John Tugger, super pumped. So I was reading Gina Martin Adams of Bloomberg Intelligence. She's a senior, chief equity strategist, I should say. And they were kind of taking that broader look on the earnings season. And she had a really interesting point. And Gina, this is why I wanted to get you on to talk about it. You guys say that if you look at guidance by the firms, looking at about 16% earnings growth, but earnings growth by analysts sees significantly less. Is that kind of gap weird?
It is unusually large. What we do find, Alix, first, thank you for having me on. Thank you for reading the work.
Oh, always. I'm a fangirl.
What we usually find is that companies' guidance is a pretty good proxy for what to expect during the earnings season. Analysts over the last several quarters have underestimated earnings, have also undershot guidance. Not by this huge of an amount, though. For instance, coming into the second quarter earnings season, analysts were expecting about 8% earnings growth. Our guidance model was saying 12. We ended up getting 14. This time around, analysts are expecting merely 4% earnings growth, and our guidance model is saying 15, 16. So It's a very big gap. I think a couple of things really explain the gap this time around. The first is, when you look at the sector concentration of guidance, only about a fifth of S&P 500 companies tend to guide earnings. That surprises a lot of people. It's not every company gives us guidance. We have to rely on a small subset of companies for this analysis. But nonetheless, of those about 100 companies that give us guidance, most of them are tech, communications, and consumer discretionary companies. So they also are concentrated in certain sectors. Now, tech and communications in particular, we know are the strongest segments of the S&P 500. We've seen that play out over the last year and a half. The weakest players in the S&P 500 are energy companies. They're still producing double-digit declines in earnings. Analyst consensus thinks they're going to give us another 20% drop in earnings year over year. They don't give us guidance at all. For the most part, they're just absent in the guidance trends. So that we could have a sector skew happening. Nonetheless, that sector skew existed last quarter, and it gave us pretty good indication that analysts were too bearish.
Maybe it's just I want to, under-promise and over-deliver from my buy-rated stocks. That's been known to happen,
Once or twice.
Yeah, once or twice. I never did it, of course. But,
No, of course not.
Yeah.
Talk to us about the Magnificent Seven and their presence in the marketplace in terms of taking this market higher. How important are they still, and maybe from an earnings perspective, too?
Yeah, well, clearly the market moves higher faster when the Mag 7 are rising, right? When the Mag 7 are leading, as we saw for the vast majority of the last year or so, the market moves up at a faster pace because they're the bigger stocks. They're the biggest market cap weightings. They do matter. You can, however, have periods of time in which the Magnificent Seven are not leading the market and you still have gains. The third quarter was a good example of that. The Mag 7 really sputtered a bit in the third quarter. We saw rotation move into other stocks. Other sectors started to break out in the month of August, reaching new highs when the Mag 7 was still struggling beneath its former peak, and stocks still rose. But the rate of appreciation in the S&P 500 does shift when your smaller players are rising faster than your bigger players. The worst case scenario is the Mag 7 falls. It's really difficult for the index to make gains when the Mag 7 is selling off because they're so big. In particular, tech and communications as whole sectors are gigantic. They're 40% of the market cap of the index.
Oh my goodness.
So when those stocks are struggling, it's very difficult for the rest of the S&P to recover, particularly at this stage of the cycle when you still have commodity prices and commodity-linked sectors operating as a drag on index and a drag on index earnings. You do need some stability in the rest of the index to overcome that earnings drag and that price drag. But they are still important. It's a matter of degree of importance. And, they're very important to the rate of appreciation in the market. they're very important to the overall trend in the market and increasingly important also as a driver of earnings growth on the S&P 500.
Right, because of the hyperscaler situation. Like the more CapEx they spend, the more it trickles down into other sectors and other companies as well. What kind of CapEx spend from the hyperscalers do you think we're going to see for next year? And how does that compare, say, to this year? And is that like a disappointment? Like what is good and bad? I'm using air quotes.
Yeah, I don't have any specific numbers on the hyperscalers in particular. I would lean on our analysts in order to sort of derive those type of nuanced expectations or micro expectations. In terms of macro, what we're seeing is companies have realigned their capital spending in line with their sales. So capex to sales ratios across the S&P 500 are very close to normalized now. We're looking at still double-digit capital spending growth, but that's down from extreme rapid capital spending growth coming out of the recession that we had in 2022. The vast majority of that improvement has come from tech and communication stocks, but you're seeing across the board more normalized capital spending, with the exception, again, of energy, where this is just a big drag on the index. The commodity-sensitive segments of the index are still experiencing low capex relative to sales. I do think that tech is a big portion of the overall optimism with respect to capex, but it's not the only thing happening. Healthcare is another area where we should see improvement in capital spending. Financials have been somewhat reticent to improve their capital spending pace, as we've been quite cautious, or many financials managers have been quite cautious with respect to the outlook. That group is starting to talk about spending on AI, for example. So that's something to watch going into 2025. The long story short is CapEx will still likely contribute to growth and likely contribute to overall optimism. The only area where we may be spending a little too much is in tech and communications, is among these companies where they've ramped up spending so fast. Sales now need to spend a little bit of time catching up to accommodate that spending pace.
So what sectors are screening well for you guys these days, Gina?
Sure. It's a strange combination of cyclicals and defensive sectors. We actually still have both tech and communications, the giants, in the middle of our sector scorecard. That happened for the first time in several quarters back in June. They dropped out of the leadership position on our sector rotation model and have been kind of sitting in the middle. Instead, it's more segments like healthcare, which was a big laggard last year, still a growth industry, but a little bit of defensive quality. Real estate is toward the top of our sector scorecard. Even some of the consumer stocks in the consumer staples group screen as relatively well-positioned given the dynamics of sectors right now. And interest rates seem to be driving a lot of choices because financials and utilities are toward the top of the scorecard as well. So the fact that the Fed is reversing policy, creating a potential improvement in lending conditions, also that rally in the long end of the curve, reducing pressure on some of the high borrowers in the index, does seem to be characterizing the sector scorecard to some degree. At the same time, recovery in laggards. So recovery in earnings laggards such as healthcare, real estate is starting to show up.
All right, Gina, super appreciate it. It was a really great piece. I love digging into all your research. Gina Martin Adams, she heads up our equity strategist coverage for Bloomberg Intelligence. Only the best for you guys here at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Crazy story out there. Southwest Airlines, one of my favorite stock symbols, love, LUV for Love Field out there in the Dallas area. They have Elliott Investment Management, calling for a special shareholder meeting, which is kicking off their firm's first U.S. proxy fight since 2017. Let's get the latest reporting on all that. Crystal C., Bloomberg US Deals Reporter. So Elliott Management, Southwest Airlines, what's the history there?
Yeah, so Elliott actually unveiled a stake in June saying that they have a significant position in Southwest. And at this point, they have 11% stake in Southwest, which is very, very sizable in percentage and in dollar amount. It worth about $2 billion. What we know here is that Elliott is calling a special shareholder meeting, which is an out-of-cycle investors meeting, and they're trying to elect 8 members into the board.
Does Love, aka that's LUV is the ticker for Southwest, does Southwest have a leg to stand on?
So Southwest actually just put out a statement. They're saying that they have made every effort to reach a constructive resolution with Elliott. We all know that proxy fights are very expensive. They're very time consuming. So I think what Southwest here is saying that they've heard investors' feedback that nobody wants a fight. And it's actually something that's very common in the activism world, that the investor would tell you they don't want to fight, company tell you they don't want to fight, activist doesn't want to fight either, but then somehow they can't come to a resolution, and here we are. The contention, the tension here is really that Southwest has said that they are backing the management, they're backing the CEO Bob Jordan, and they have already done enough board refreshment, whereas Elliott thinks they need a control in the board to make further changes.
Well, as you point out, I mean, in your reporting here, Elliott's, they do this a lot in terms of activism, but what they don't typically do is take it to a shareholder vote. They usually get what they want, I guess, before then. What's different here, do you think? Yeah,
so they have never done a U.S. Proxy fight since 2017, but this is quite significant in the activism world. They are usually very effective. The second they show up in any stock, immediately the company take them very seriously. They try to come to a resolution because, like I said, proxy fights lengthy and costly. But Southwest here somehow it just evolved into this, and that at many points people thought they could have resolved, but I guess there's some differences here. What
does Elliott want Southwest to do that Southwest is not doing? Because you would think at this point it'd be like all options, all hands on Southwest deck here.
Yes, so Elliott has asked for 3 main things, which is leadership change, management change, board change, as well as operational improvement. And they've kind of pinned this on the CEO Bob Jordan this whole time, saying that he's not the right person to execute whatever strategy that the company has put out. The company has said they would add revenue, they would cut cost. They even had an investor day in late September, and none of that kind of, fulfilled Elliott's demand, which is a majority in the boardroom. So this is where we are, and they're calling it, requesting a meeting for December 10th, which is one of the busiest traveling season in the US, in the world. And so it's an interesting timing, and this is also one thing that Southwest is pointing at, is they call this a selfish request in their statement, saying that it is a time where Southwest should be executing. Southwest,
they in July adopted a poison pill. So they're taking this seriously. For sure.
Yeah, so a poison pill is, something that stops someone from a hostile takeover. And Elliott at that point had close to 10%, and 10% is a threshold to call a special meeting. And the poison pill is for 12.5%, so it stops Elliott from getting more shares than that. And once they do, acquiring more share would become really costly. So it's also a kind of rare occurrence these days. Not a lot of companies put in poison pills, but again, Southwest is full of surprises.
Yeah, tell me about it. Just before you go, when these things unfold, is Elliott Management's what they want now? Here's the best bid, but I'll take a little bit less. Or do they really want to replace all these board seats, et cetera, et cetera?
So from our reporting, actually both sides have spent a lot of time trying to figure out how to not go to a fight. Whether we can do Elliott had asked for majority seats. So at one point they nominated 10 directors, and then Southwest came back and said, well, 6 of our directors left. We have 3 seats open. Would you take 3 instead? It's always a constant negotiation. Is it 3? Is it 10? And I'm sure everything has been discussed. Everything on the table has been talked about. And but this is it. This will be up to shareholders to vote on who actually gets the majority in the boardroom.
All right, Crystal. Thanks a lot. Really appreciate it, Crystal C. joining us, Bloomberg US Deals Reporter. That's kind of fun. It's something to talk about.
I know.
I like it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside John Tucker and Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Those bond guys are still sleeping, but we're here and we're definitely working. Also working, Kristina Hooper, Chief Global Market Strategist over at Invesco. She joins us now in studio. Kristina, I keep joking, but yeah, okay, it's 46 record highs potentially if we close at these levels for the S&P. Do you buy it? As in, are we climbing a wall of worry? Or is this like a fundamentally lead-driven rally, and do you buy it?
I do buy it. So for a few reasons. First of all, we have central banks at our back. And it's not just the Fed easing. We have a number of central banks easing. It's an environment of accommodation, and that is supportive of risk assets, including equities. And I would argue that is the single largest driver of markets right now. But we also have an economy that is on pretty solid footing in the United States. And actually elsewhere, not so bad either. We're getting stimulus from China. So I think the global picture is quite good. But in particular in the U.S., I think that this is an economy that is going to slow only modestly and then is going to quickly reaccelerate probably by the end of this year, early next year.
All right, given that background, stocks versus bonds. Let's start there.
So I think there's a place for both in one's portfolio. It's important to be well diversified. I would err on the side of an overweighting of stocks relative to bonds, but I still see an attractive picture, especially now that yields have backed up, as an entry point for fixed income. This is an economy, I mean, in a normal environment, what we would see is the Fed cutting as an economy is in bad shape. Mm-hmm. This is a very different scenario. Yep. So we can go out on the risk spectrum when it comes to fixed income as well.
Isn't the reacceleration, though, a risk? Because if you get really reacceleration of growth and inflation, that means actually the Fed's going to have to revert and start hiking again. Is that a scenario for you?
Well, that's certainly a risk, but I think it's an unlikely risk right now. And I'm looking at 6 months out, and what I see is an attractive picture for equities. And let's face it, if we get to an environment, I think what's much more likely is that we have a Fed that slows down its easing. And I'm very comfortable with that because it's slowing down its easing for good reason.
So what do you think the Fed will do for the remainder on the next 3-4 meetings maybe?
So I think that for this year, we're probably only going to get 25 basis points more. And I'm very comfortable with that through the end of 24.
Okay.
And then I think we will see continued easing next year, and we'll probably get maybe 100, 125 basis points if all goes well with this economy, which, knock on wood, will happen.
If we do... Tucker, did you have something?
No.
Oh! I thought
I'm
he was
just talking
to
to
me.
myself.
Oh, okay, good. It's a distinction we need to make here in
ignore
radio.
the man over there.
But if we only get 25 for the rest of the year and we have to price that out, does that cause turbulence in the market, or do you think then earnings will be strong enough to show, guys, we're good?
I think so. We have gotten only a little bit of earnings season thus far, but my takeaways are that the consumer is quite strong. Yes, there's weakness in lower income consumers, but the overall picture is a positive one. Companies are in pretty good shape. There are plans to do more business travel next year. We're seeing a lot of different areas of real strength with a few pockets of weakness. So I think that absolutely can be the picture and can, I think, encourage investors to continue to move stocks higher this year.
So are there sectors here that you want to play here? Because I'm just looking just at today's action. You know, the best performance has been some of the tried and true Mag 7, the NVIDIAs, the Metas, the Googles of the world. Are you comfortable still making that play, or are you looking for value or in other parts of the market?
So this is an environment that will support a big tent under which many asset classes can exist. Although I do think the greatest potential from here are the smaller caps and the cyclicals because they are so closely correlated with the economy. And if you believe there's going to be an economic reacceleration, then, and I would argue for at least a modest overweighting of the cyclicals and the small caps.
It's interesting you say that because we had an article out today on the Bloomberg that talked about how the Russell is still, 10% below its record highs, but the small cap 600, which has more exposure to say quality, is almost near that 2021 record. So is there a distinction within that small cap space?
Well, I certainly think there is a distinction right now, but that could change. Again, we are just at the start of what could be a significant economic reacceleration. So I won't dismiss parts of the small cap universe. What I would say, though, is that right now, as there is still some hesitancy and apprehension, there's a fair amount of uncertainty about a lot of different things, including what the Fed's going to do and who's going to win the presidential election. We're likely to see more of a focus and a desire to be in quality.
INGO, the Bloomberg Index browser, shows me kind of how the fixed income market is behaving, even though they're not working today. By far, the best performance has been U.S. corporate high yield. Is that played out, or is there still opportunity there in high yield, do you think?
I think there's opportunity there. It's not a surprise to me. In fact, I go back to the last time the Fed was able to successfully tighten and avoid a recession. So that was 94, 95. They began to cut in 95, 96. And if you look at the first 6 months of performance for a variety of different asset classes, as the Fed started to cut, high yield bonds did very well in that period. And I'm not surprised because they were cutting into a good environment, not dissimilar to where we are today.
Do you think that the post-election makeup will be a headwind or a tailwind? I can see a case for both, right? You get a headwind, corporate taxes and tariffs. The tailwind is uncertainty removed in some capacity. Therefore, there's been CapEx, companies on the sidelines not doing stuff they want to do, and therefore they go do it. Which camp are you in here?
I think it's going to be a net positive because we are going to see people coming off the sidelines. We saw in the Federal Reserve Beige Book, and we're hearing it in some of the earnings calls, that there are companies and consumers that are sitting on their hands right now. And so I think that encourages them to come back in, spend more. So I think it's a net positive. Also, I hearken back to the view that it is the Fed that is a far more important driver.
Earnings just starting here. What do you need to see from corporate America this earnings season?
Well, I think they're going to beat expectations. That's what we need to see, and I think it's going to be very easy to do that. Expectations have been managed well, have been essentially downwardly revised, and so it's going to be they're going to be able to beat expectations by a significant amount, and I think that's really all we need to see. Also, I think it's important the guidance that we get for the future, and I think we will get relatively positive guidance.
Can we broaden out for a sec?
Sure.
Where else outside the U.S. is a good opportunity?
Well, I'm excited about UK equities.
What? Said no one literally ever that I've spoken. That's not true. One or two people maybe in my time. How come?
Well, valuations are very attractive.
As they have been forever.
Okay, but the catalyst is that we are now in an easing cycle, and that certainly will be a helpful driver. It's also an economy that's actually in relatively good shape. Now, consumer sentiment has turned negative recently, and I think what we're seeing is a sitting on of hands, not dissimilar to the U.S. right now, because everyone's waiting and worrying about the autumn budget. But once that has been released, I think we can move on from there, and that could very well be a catalyst in and of itself.
We just had Keir Starmer on saying that
did.
the UK is open for business.
I bet he did, yeah.
So,
yeah.
All right. So, AI, it seems like the AI hype in the market has kind of faded a little bit. And now people are starting to think about, I don't know, mundane things about getting returns on investment and use cases and so on and so forth. How do you guys at Invesco, how do your tech people, what do they tell you about AI and what you should be paying for it and how you should be getting exposure to it?
Well, when we think about AI, it's really about how it can help companies and how it can help the economy, as opposed to, I'm not thinking so much about myself. And so I'm excited. I think that certainly there has been a trend towards overinvestment in AI. But companies are making a rational decision and saying that it makes sense, that the opportunity cost of not investing, that risk is far more significant. And by the way, there are some ancillary benefits to investing, that it structurally improves their technology in general. And they're better poised for the future as a result. We're already seeing that companies are getting benefits from their AI investment. On an earnings call last quarter, I believe it was Walmart that talked about how AI has helped with online sales. And that is not an anomaly. A number of companies are seeing that. And that's just the low-hanging fruit. I think we're going to see AI pay dividends for years to come.
So pause into AI, and I want to talk about China, the ex-US there. So just quickly, we have about a minute left. If you're talking about a global easing cycle, in essence, with the exception of Japan, does China fit that bill for you?
Absolutely. It is a very stimulative environment right now in China. And it's not just monetary policy. We're getting fiscal stimulus as well. And I think that is very compelling.
A lot of China folks felt like it wasn't enough. And I guess some people are saying, yeah, maybe it's not enough, but there's more to come, so don't worry about it. I mean, I don't follow that closely. Do you? Is it?
So I think it's more about we don't have enough details yet. Although I'm excited, they're slow rolling out details, but everything we've heard thus far suggests these are going to be more structural reforms aimed at supporting the economy over the medium and longer term. So we might not get that immediate payoff, but as details continue to emerge, I think the picture will get more and more positive.
Right. They're just not like cutting checks right now to like help stimulate. It's a little bit more nuanced. Kristina, it's so good to see you. So thanks so much for coming in. We really appreciate it. Kristina Hooper, Chief Global Market Strategist over at Invesco.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube. That is the internet, I've been told. Go to youtube.com, search Bloomberg Live Radio, and that's where you will find us. I covered the media industry for a long time, and boy, when I was covering it, everybody was making money. But man, the last 7, 8, 9 years, it's been a really tough place for investors to find consistent shareholder returns. And the big challenge for global media has been this thing of cord cutting. I mean, it used to be such a great model when 100 million American homes were paying, $100 a month for all kinds of 500 channels and all that kind of stuff. But since the cord cutting has really escalated or accelerated over the last several years, it's been really a tough business model, and the companies are trying to adapt, investors are trying to adapt. And I'll tell you, the analyst who called this out first, in my opinion, and the loudest, highlighting it as a risk for global media, was Rich Greenfield. He's a partner and co-founder of LightShed Partners. He joins us here. Rich, again, from my perspective, you were absolutely one of the first, if not the first, to really highlight this cord-cutting risk for global media. Can you step back and help us think about where we are today and where we go? Because I'm just not sure when and if to invest in a media company anymore.
Well, look, I think it's really hard. There's no doubt that cord cutting has accelerated, and because cord cutting has accelerated, all of the legacy traditional media companies have all jumped headfirst into streaming. But as they've done that, they've actually, to make the streaming services compelling, they've pushed all of their great content to their streaming services. So you don't, outside of live sports, there isn't a whole heck of a lot that's really compelling. Sure, you've got news if you care about MSNBC or Fox News, although even CNN you can now get as part of Max. And so the number of things that you need the traditional bundle for has really shrunk pretty dramatically. And I think, as you get more and more streaming services with great content and all the original content that you can't find on linear, it's pushing more and more people to cut the cord. Or even if they don't cut the cord, maybe they're a subscriber for part of the year, but nobody signed up for Comcast or Charter Spectrum. Nobody used to sign up for 3 or 4 months. Now you can signing up for YouTube TV for a few months is easy. You can watch for football season, or if you love postseason baseball, go sign up. Then you can cancel. I mean, it's just so easy to come in and out. But
it's
those dynamics are so different from the way it was, where nobody called up Comcast to have them rip the equipment out halfway through the year.
So to that point, I feel like saying this is going to get me in trouble somewhere. Why is linear TV still a thing?
Linear TV is, I honestly think the only reason there are 67, 68 million homes paying, upwards of between 75 and 120, probably $5 a month, is live sports. I mean, sure, there's definitely an older demographic that has been doing it and, will never churn. But I think the reason why you have millions subscribing to YouTube TV and Hulu Live and continuing to take Comcast is for live sports. I mean, if you want to watch all football games, college, pro, you need a subscription to cable, satellite, or one of these over-the-top like, YouTube TV bundles. There's no getting away from it. You still can't. Sure, can you replicate a bunch of it in streaming? Yes, next year you'll be able to get even ESPN direct to consumer in September 2025 when, Iger finally pulls the trigger on that. But if you want to watch Fox Sports, Fox football games yesterday afternoon, there's only one way to do it, which is sign up for a bundle.
All right, Rich. So if I'm the management team, if I'm the board level at some of these linear media companies, what do I do? Is there ever a world when I can generate the profitability and the returns that I did 6-7 years ago, or is that model just gone?
Look, I think if any of these companies was able to get up into the top echelon, to be a dominant player in streaming, that's certainly possible, Paul. I mean, I wouldn't think saying never is sort of difficult. But right now, I'd say all of these traditional media companies, the one thing they're struggling with is they're really optimizing for the wrong thing. They've been focused on, initially they were just focused on subscriber growth.
Yep.
And so they just gunned it for subscriber growth. Profitability didn't matter. They were just, losses were piling up, billions, I think, between all of the major companies. I think they were losing like upwards of $12 billion if you aggregated it all together between Disney and Warner and Peacock. So they realized that's not sustainable. So now they've been, slashing the amount of programming, slashing the marketing, raising the price. And the thing that they're all missing is they're not gunning for time spent. Like Netflix never wants you leaving. Amazon never wants you leaving. I think the challenge for all of these companies is they're stuck in this weird middle of like, they don't have enough scale. They don't really have the balance sheets to invest aggressively because they're dealing with, just as you were talking about at the beginning of this interview, the pressure from cord cutting on the linear business. We didn't even talk about advertising, which is under pressure. So your core business is under pressure. It's very hard when your core business is under pressure to deploy even more capital to really gun it in the new business. And so you're stuck in this sort of what I would call this sort of ugly middle where you don't have enough scale, you haven't hit scale, and you don't really have a clear path. You're sort of hoping for consolidation, whether that's streamer consolidation or whole company consolidation. But it is certainly a very difficult place to be. And I think if you look at this stock, all of these stocks as a group, it hasn't been pretty. I don't care whether it's Warner Brothers Discovery or Disney, even Comcast. Like this whole space has not been a great place to make money. And I don't think in the next 12 months, do I see any green shoots or some major change that's going to make you say, oh my God, this space is on fire? The answer is no.
Hey, Rich, before I let you go, Tom Keene wanted me to ask you here, Warner Brothers Discovery. Can you give me 30 seconds on that name?
Look, it's David Zaslav has to prove to Wall Street. This is purely a David Zaslav execution story. They didn't renew the NBA. Yes, they're suing. I think there's highly unlikely to win that suit. But the key question for the future of WBD, Warner Brothers Discovery, is was dropping the NBA or not renewing the NBA, is that existential? Because if they can get their deals done with Comcast and other distributors over the coming year, then getting rid of, what would have been $2+ billion of cost is a home run for the stock.
I see. Okay.
Investors don't believe it. Investors believe that this is a catastrophic loss, that they're going to get maybe not dropped by Comcast, but a severe reduction in fees. And so this is purely, can David Zaslav prove to investors that they are strong enough to withstand the loss of the NBA? You're going to find out over the next 6 months.
All right, Rich, always great to talk with you. Really appreciate you taking a few minutes of your time. Rich Greenfield, he's a partner and co-founder of LightShed Partners.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. Every day, Bloomberg puts out a big take. It's great stuff. You can get it on podcast, you can get it in print, you can get it on Bloomberg.com and on the terminal. And today's big take story is cat bonds will help Florida but failed Jamaica. So that story is part of Bloomberg Green's investigation into how climate change is making parts of the planet uninsurable, leaving millions of people without a safety net. And the point is that governments and companies aren't prepared. And this is part 3. So we want to turn to Bloomberg ESG editor Gautam Naik, who joins us now. Walk us through this part 3 of this series that you guys have been doing.
Sure. Good to be on the show. So essentially, this particular story I've done with a couple of colleagues looks at catastrophe bonds. These are a bet on the probability of huge natural disasters like earthquakes, wildfires, floods, or hurricanes. And obviously the incidence of some of these events has gotten higher, and the severity of some climate-related events like hurricanes and floods have become more intense. So these catastrophe bonds are a way for insurance and reinsurance companies to pass on the risk of growing disasters onto Wall Street, onto the capital markets, and not to put it on their own balance sheet. The way it works is that if you're an investor in the bond, you can make a very large return that could be hard to find in another fixed income product. However, if the particular disaster that's defined in the bond does occur, then you could lose some or even all of your invested capital. So it's a gamble on a weather disaster.
Very simply, do these work?
Yes, they absolutely do work. So just to give you the broader context, about 70% of all catastrophe bonds are focused on the U.S. windstorm sector. It includes hurricanes and other severe named storms. And a big chunk of that relates to Florida. Obviously, this came into focus recently because of Hurricanes Helene and Milton back-to-back that caused a lot of flooding and wind damage as well. And the way it works is that if a particular threshold of losses is met for most of these catastrophe bonds, then the issuing party will get a good chunk of the money. That's taken out from the money that the capital markets, the Wall Street investors put in when they bought the bond. And that money then goes to fix people's roofs and, rebuild homes.
When has it not worked? As I mentioned, the title was they helped Florida but failed Jamaica. So what's the scenario where they don't pay off?
Yeah. So catastrophe bonds have been around for about 25 to 30 years, and they've largely developed, as I said, in the US, but also in Europe and Japan against earthquake risk. But increasingly, institutions like the World Bank, the IMF, the OECD are trying to popularize them in the developing world. Now, this is a part of the globe that is being disproportionately hit by a lot of climate losses to which they're not directly linked because, most of the emissions have come from since the Industrial Revolution in the western parts of the world. But a lot of these weather disasters are being, focused on the, southern hemisphere. So the World Bank and other institutions are trying to get developing countries that are facing these risks to issue these catastrophe bonds that have been around in the West. But there is a problem. The way the bond is structured in the West, the way it's developed, seems to work quite well. But in a developing country, because they don't have an insurance market, you can't actually calculate the total claims on an insured basis. So they've come up with a different way of structuring the bond. It's called a parametric approach. Basically, for a hurricane, it would simply be if the pressure of the hurricane hits a certain threshold, which indicates wind speed, then the bond will pay out. But if it misses, you get nothing. Even if you miss by the tiniest fractions, the rules say you will get zero. And that's sort of what happened with Jamaica.
It would seem like if you believe in climate change and if you believe that weather's going to become more and more unstable, it might be really hard to price the risk out here because it seems like the risk would always be going up of more and more, again, unstable weather and catastrophes here. How does the market account for that?
You've pinpointed a problem. So when someone's trying to calculate the risk of these kind of weather-related catastrophe bonds, all you have really is historical data. So for hurricanes, you have 150, 170 years of pretty robust data going back, and you can make a good estimate. But unfortunately, the calculation has been muddied now with climate change, and these forecasts are of course forecasts. It's something that hasn't happened yet that will project it to happen, but you just don't know how it might unfold depending on how the world reacts to increased CO2 emissions. So the whole question is, how do you incorporate the climate effect into this historical data and provide a really reliable metric for someone to make a financial bet on? And it's the uncertainty of, well, to some extent, the models that are used. They're by no means perfect, but also this extra new element that we've seen in the last few decades of climate change.
So you guys, as I mentioned in the beginning, this is part 3 of a series that you guys have done into how climate change is making the planet uninsurable. What is your key takeaway here?
I think one of the main takeaways would be that it is very hard to accurately model the risk of climate change, and of course there are attempts being made to refine it constantly. But if you're trying to insure a large proportion of the world that is not insured in the developing world, also parts of Europe. I mean, there's a huge insurance protection gap in Europe and even in the US. For example, in Florida, insurance companies are moved out. They're not providing insurance. In California, for earthquake risk and wildfire, they're moving out. So the main takeaway is that it's becoming a more difficult problem. It's becoming a more uninsurable planet because of climate risk.
All right, Gautam, thank you so much. We appreciate that. Gautam Naik, ESG Editor for Bloomberg News, joining us on Zoom from London. You can read Gautam's story and more from Bloomberg, the Big Take, on the Bloomberg Terminal and at Bloomberg.com/Big Take. Some good stuff there, some great reporting, some great graphics. I always like the graphics. Folks do some great jobs to bring the stories to life there. As well, illustrations for this story by John Preventure for Bloomberg Green. Like to call him out. So, I would think, boy, if I'm trying to structure a bond, I'm like, I don't know what the risk is of this thing. It just seems like it's getting worse and worse every year.
Well, here's my question then, too, is that say you're able to finally figure out the correct structure, right? Then the weather changes again.
Yep.
So then how do you manage that part, right? So just because you might have, huge windstorms in one area now, are you going to have them in 15 years? Or are you going to have solar issues? Or is it going to be floods? It's something different. Then how do you manage that?
Yeah. If I'm an investor in these bonds, I'm like, you better pay me a huge rate.
Which they do, to be fair. Yeah.
Okay. So, yeah.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And every week around this time, we tap our amazing resource over at Bloomberg BNEF, previously known as Bloomberg New Energy Finance. BNEF basically tracks everything that you need to know, from commodities, power, transport, industry, buildings, ag, as well as how to finance the energy transition. And joining us now is Kyle Harrison, Head of Sustainability Research at Bloomberg BNEF. He joins us now. So let's take a look at corporations and how many and what kind of corporations have signed green PPAs, known as power purchase agreements, which is basically like they're getting their electricity and power and stuff through green things.
Exactly. So they're locking into long-term contracts for typically solar or wind power, but we're now seeing them expand into other forms of low-carbon technology. For example, like nuclear, like hydro, and like geothermal. Big technology companies have really led in this space. So it's the companies like Amazon, Meta, Google, Microsoft. They're signing the most deals at a large scale, but we're seeing a lot of heavy emitting, hard to abate sectors getting into this space now. So materials companies, industrials, oil and gas companies, they're starting to break into new markets where big tech maybe doesn't have as big of a footprint, and they're starting to sign these long-term, large-scale clean energy deals.
Where are the clean energy deals happening? Is it here in the U.S.? Is it in Europe? Where are these things mostly happening?
Historically, it was the U.S., so between 2015 and 2022, around 2/3 of all these corporate clean energy power purchase agreements were signed in the United States. In 2023, that number dropped to around 45%. So corporations are increasingly spreading out and signing deals in Europe, in Latin America, and Southeast Asia, for example. In Asia in particular, you have a lot of demand for electricity from corporations, and you have a huge supply chain footprint. And historically, those companies haven't been able to buy clean energy. But through a lot of policy lobbying and a lot of work on the ground with regulators, you now have opportunities to buy clean energy in Japan, South Korea, Vietnam's a new market. So there's a lot of new exciting expansion.
What's the price for these things, and how do they compare to traditional energy?
So that's been one of the biggest drivers in the growth of this market, right? So through September of this year, companies have announced over 31 gigawatts of clean energy through corporate power purchase agreements. That's the size of a small country in a given year. And we're on record pace, and the biggest reason for that is that solar and wind on a new build basis are now cheaper than coal and gas in many markets around the world. So as a corporate buyer, I can undercut those prices for power that I might be paying, for example, from a utility or from the grid by locking into a long-term fixed contract for renewables.
And for renewables, is the adoption of renewables or the growth of the renewables market, is that driven by the market or by regulations, government saying you got to do this? What do we learn?
I mean, to the last question, it's really primarily driven by economics, but reliability is a huge factor here, right? So big technology companies, they're now going out, they're building these data centers. You're seeing a big expansion in manufacturing capacity. All of this requires the lights to be on 24/7, right? So you can't afford to have a power outage or a grid failure. So locking into one of these contracts for solar and wind, that gives you more reliability. And again, that expansion into other forms of what we would call zero carbon baseload power that could generate 24/7, like nuclear and geothermal, that also kind of emphasizes that reliability. So it's a combo of that along with sustainability.
And how do you think that this sort of partnership and evolution happens? It's still going to be these long-term power purchase agreements, or is it going to be like these hyperscalers and, maybe even like a cement industry or the hard-to-abate industry just sets up like their little small modular reactor right next to their facility, or a wind farm right next to their facility? I mean, I'm hyperbole, but you get the idea, versus plugging into the grid, for example.
You definitely need collaboration on the grid side, right? And the utility scale side of this market. Of course, there are opportunities to build a solar project or a wind farm on site and leverage energy storage to get that power directly. But we need utilities, right? And we need grid planners to start collaborating with these corporate buyers to ensure that this grid scale up is done sustainably. If we start to build all these hyperscaler data centers in, for example, the data center corridor in the eastern US or in Texas, you need to ensure that there's enough transmission capacity to ensure that that power gets moved from A to B, right? So that starts to involve regulators, that starts to involve utilities. So it really is kind of an approach that everyone needs to be involved in for this to be successful.
You know where they do wind farms in a big way? Ireland.
Ooh,
Driving
did you
around
see
Ireland,
some?
tons of them.
A lot of data centers in Ireland as well, so it's extra important there.
All right. So they were everywhere, and just big ones as well, and it's windy there, so it works. Being an island and all. Talk to us about, you mentioned nuclear energy. What's the future of nuclear here in this country? Can't we build these little nuclear plants that can do things and not pose a big risk?
So I unfortunately I can't comment too much on nuclear as a
we
technology.
have a nuclear guy?
We do have a nuclear guy. I'll leave it to him.
This
but
BNEF thing.
What I would
there's
say,
like 5 people there.
what I would say is, right, there was a lot of noise around this announcement from Microsoft around 3 Mile Island.
Right.
3 Mile Island is a name, right? That's a project that obviously evokes a lot of emotion. But we're going to see a lot of corporations continue to look for those deals with that zero carbon baseload power. So we wrote about this the other week. This won't be the last nuclear deal from big tech, right? You'll see more geothermal deals. So it's going to play a really important role here as a reliable source of power that's also low carbon.
What I think I understand, though, from that particular agreement is that the 3 Mile, so Constellation Energy will revamp its nuclear reactor and turn it online into the grid. Then Microsoft will pay the difference to Constellation Energy from what it would cost to get from the grid versus this nuclear facility. So it's like done differently. It's not like the nuclear is going to like plug right into a Microsoft hyperscaler. It's like they're still going to take from the grid. So it's all these like weird agreements that I feel like you're going to have to.
Did I tell you I read a book called The Grid?
Did you?
Did I?
They're joking.
Very good.
They're very excited about reading the grid, and then now they think
Because
about
we're now
grid.
geniuses on the grid.
Yes, exactly.
As
So
one
anything
should
you want to
be.
know? Just let me know.
Anything, they got it.
Yep.
What region is signing the most of these clean PPAs?
Right now it's Texas, and it's based purely on economics. So in, for example, northern and western Texas, the price of power for wind is incredibly cheap, and you have fantastic wind resources. So you have a lot of companies going out and signing deals there. But increasingly, companies want to emphasize where can they make the biggest impact by adding clean power. If you already have all of this low carbon wind and solar generating in Texas, are you really making that much of a difference by adding another project there? For example, compared to the eastern US, where you have more coal power, right? Where you can have a bigger impact on decarbonizing the grid. So what we're going to slowly start to see is more corporations expand that footprint, both to other parts of the United States outside of Texas, but other new regions in the world as well.
Who burns coal in the US anymore? We still have coal?
Well, I mean, I guess we can follow the lead of the UK, right, which just retired its final coal project.
But they still have them, right? They're still.
John, are you burning coal there in the abode?
I do have a bag of coal in the basement.
Yes, he does. He's
Don't
gonna
we
be,
all?
John Tucker's going to
I
be the
don't
last
know if
coal
you're
burner.
actually kidding.
No, I actually.
Yeah, that's the thing. He's not. All right. Thanks a lot. We really appreciate
last
Kyle
holdout.
Harrison, the last holdout.
Yeah.
Bloomberg BNEF's head of sustainability research, joining us on those trends in sustainability.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.